Have you ever looked at a stock and just felt completely lost, drowning in numbers and charts? Well, today we're going to fix that. I'm going to give you a simple, powerful framework that cuts right through all that noise and helps you analyze any stock in about 30 minutes, focusing only on what really, truly matters. You know this feeling, right? You've got 50 browser tabs open, you're buried in financial reports, and you just feel stuck. That's analysis paralysis. It's that frustrating wall we all hit where we're so overwhelmed with information that we can't make a decision at all. But what if there was a better way? What if you had a clear, step-by-step game plan that you could use on any company to quickly figure out if it's worth a closer look or if you should just move on? That's exactly the process we're going to build today. So here's our game plan. We'll start with the framework itself, then we'll break down the 6 essential steps to get you to clarity. After that, I'll show you how to pull it all together in a final scorecard, and hey, even how you can automate this whole thing. Okay, so here it is, our 30-minute framework. Now let's be clear, the goal here isn't to become a world-class expert on a company in half an hour. No way. The goal is to efficiently find the critical signals that tell you if a stock is a potential yes, a hard no, or maybe a maybe that deserves more of your time. These are our 6 steps to clarity, and I want you to notice something really important about the order here. We start with the story, the qualitative stuff, before we even touch a single number. Then we move methodically through the quantitative checks. Is it profitable? Is it safe? Is the cash real? Is the price fair? And is it growing? Each step just logically builds on the last. Let's jump right in with step 1, the business overview. And this is so crucial. Before you even think about looking at a spreadsheet, you have to understand what the company actually does. This is the foundation for everything else that follows. You need to be able to answer a few really simple questions. What do they sell? Who buys it? What's their secret sauce? Their competitive advantage that keeps rivals at bay. This is what the great Warren Buffett calls your circle of competence. And there's a simple rule of thumb. If you can't explain what the business does in 2 simple sentences, you just move on. Seriously. Okay, so we understand the business. Now we can start looking at the numbers. And that brings us to step 2, the profitability check. This is pretty straightforward. Does this company actually make money? And how good is it at doing so? You see, profitability isn't just one number, it has layers. First, gross margin tells us if they have pricing power. Can they charge a good price for their stuff? Then operating margin shows how efficient the core business is. And finally, net profit margin is the bottom line, what's left after all the bills are paid. Now, these numbers, over 40, 15, and 10% are fantastic benchmarks, but always remember to compare them to that company's direct competitors. Context is everything. But if you could only look at one single profitability metric, this would be it. Return on invested capital, or ROIC. It answers the single most important question. For every dollar the company invests in itself, how much cash does it generate? If you see a consistent ROIC above 12%, that is a huge flashing green light that you're looking at a high-quality business. A profitable company is fantastic, right? But is it built to last? Can it survive a recession? That brings us to step 3, checking the balance sheet for safety. This is all about financial strength and resilience. We're going to look at 3 key numbers here. First, the current ratio. Simple question. Can they pay their bills for this coming year? We want to see a number over 1.5. Next, debt to equity. How much do they rely on borrowing? A number under 1.0 is generally a pretty safe spot. And finally, the Altman Z-score. It sounds complex, but it's just a formula designed to predict bankruptcy risk, and to score over 3.0 basically means the company is on very solid ground. All right, now for a check that's a little more advanced, but trust me, it's unbelievably important, earnings quality. You see, the profits a company reports, their accounting profits, can sometimes be a bit of a mirage. What we really care about is whether those profits are turning into actual cash in the bank. And the best way to check this is with the operating cash flow to net income ratio. All you need to know is this. If this number is consistently above 1, it means real, cold, hard cash is backing up the reported profits. That's a huge green flag. If it's consistently below 1, you have to start asking some tough questions about where the cash is really going. Okay, so let's say we've found a great, profitable, safe company with real cash flow. Awesome, but we're not done yet. Step 5 is the valuation sanity check. And here's why. Because even the best company in the world can be a terrible investment if you pay too much for it.
This brings us to what I call the classic PE trap. You see a low price-to-earnings ratio and you think, wow, that's cheap. But that low PE could just be a warning sign for a dying business. On the flip side, you might see a high PE and think, whoa, that's expensive. But it could actually be a bargain if the company's growth is off the charts. The key takeaway is that valuation without context, specifically the context of growth, is totally meaningless.
And that leads us perfectly into our final step, step 6, growth trajectory. Is this business actually getting stronger over time? Is it expanding its sales, its profits, its efficiency? This is where we look at the trend, the bigger picture. And really, this is the holy grail of investing, finding this powerful combination. We don't want growth for the sake of growth. We want profitable growth. Think about it. A company growing sales at 15% a year while also earning a super high ROIC of, say, 25%, that's the dream. It shows you a fantastic business that's getting stronger as it gets bigger. So, we've powered through all 6 steps. Now what? Well, this is the best part. This is where we bring it all together into a simple, actionable scorecard that tells you in a glance whether to dig deeper or just walk away. This is it. This is the output of your 30-minute analysis, a simple checklist. For each of our 6 questions, you give it a clear check mark or an X. Is the business understandable? Check. Is profitability healthy? Check. Is the balance sheet solid? X. See? It turns a mountain of data into a straightforward yes or no summary. And here is your decision framework. It's that simple. If you get 5 or 6 check marks, you've likely found a strong candidate that really deserves a much deeper dive. 3 or 4, it's a mixed bag. You need to proceed with caution and understand the weak spots. And if you get 2 or fewer check marks, it's an easy pass. You just move on. This process keeps you disciplined and focused only on the best opportunities. So now you have the manual process. But what if you want to do this for dozens of companies without spending your entire weekend drowning in spreadsheets? Well, the great news is you can put this entire framework on autopilot and seriously level up your learning. This entire framework is actually based on the methodology from Finstill. That's spelled F-F-F-I-N-S-T-I-L-L, and it's pronounced Finstill. It's a financial analysis platform that has essentially taken this whole 30-minute process and automated it, calculating all these key metrics for thousands of stocks in an instant. But Finstill is way more than just a tool. Think of it as a huge learning library. We have over 300 free financial learning concepts and guided learning paths to take you from a total beginner to a pro. You could even use the stock screener to instantly find companies that meet every single one of these criteria we just talked about. So if you want to keep getting smarter about investing, make sure you follow and subscribe so you don't miss our next explainer. So the power is now in your hands. You have a repeatable, powerful framework to analyze any stock out there with confidence. The only question left is, which company are you going to analyze first? Thanks for tuning in.